Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Rob, great to be back with you this week. Hope you're doing well. I was about to ask you what's happening or how are things in the UK, but I actually got home from the UK yesterday, so I've kind of have a feel for what's going on. But tell me what you're seeing in the UK.
Niels, you mean you went to the UK and you didn't come and have lunch with me yet again?
I know.
This is like the second time in a year, I think, that you've done this.
Could have been.
Yeah.
But anyways, how are things in the UK?
Yeah, they seem to be okay. We had yesterday, we had the budget, which is everyone makes a massive fuss about. It is, I don't know if this is a uniquely British thing, but this budget thing where every year the Chancellor announces all of his tax and spending stuff, and it's kind of a big public event, and the media are obsessed with it for about a week before and a week afterwards. I don't think any other country has quite the same level of, sort of analysis around one single day on this stuff. Obviously in the US they have the budget ceiling and there's ongoing arguments about that, but this kind of one day a year obsession thing I think strikes me as very uniquely British. So it's quite boring actually.
Well, you say it's boring, but I remember a couple of years ago where there was something to do with a budget and some tax cuts that certainly put a bit of a spinner in the wheel in the UK.
I mean, if we're going to be pedantic, that was a fiscal event and not a budget.
Okay.
And boy, was it an event. Yeah. So yes, you're right. They're normally boring. I guess they should be boring. And if they're not boring, then that's problematic because the last thing you want to do is surprise people. They always want to surprise a little bit on the upside because politicians like to, as they say, pull the rabbit out of the hat. A sort of very modest, bedraggled rabbit was pulled out of the hat yesterday. So some people are saying now that chance of an election in May rather than waiting like several months to the last possible minute is more likely. So, yeah, I guess we'll see.
Anything else sort of more close to our industry trading, but not necessarily one of the topics we're going to talk about that sort of popped up on your radar? Or has
Niels, do you really want me to talk about crypto? I know, I can tell. I could just tell. The people at home, obviously listening to the audio, can't see this, but Niels' his laser eyes are kind of coming through his glasses a bit. So, I think he's very much. I think wanting me to talk about the fact that obviously the Bitcoin, the thing I hate, recently reached new highs. That could be because of I guess a lot of people are saying it's inflows due to the fact you can now buy these ETFs, physical ETFs, spot ETFs, rather than previous ETFs that are purely futures-based. I had a rant on my previous appearance on the show about them, so I'm not going to repeat that rant now. Everyone knows my feelings, but yeah, I guess it looks like there's some net excess demand from people. I'm guessing probably more institutional people who don't want the hassle of actually, kind of working out how you actually custody this stuff safely. They say I want to kind of hand it off to an ETF. Of course, ultimately the ETF has to custody it as well, and these things are mostly being custodied through I believe through Binance. I think they're the main firm that's doing this stuff. So a firm that's obviously had run-ins with the SEC. So how safe that custody option is, I don't know. So I do feel like, buying a physical ETF and saying, well, someone else can worry about the custody, I don't have to, isn't necessarily going to, isn't necessarily cast iron protection, I would say. So, but we'll see how it plays out. I kind of look upon the crypto space as a sort of, in a kind of vaguely disinterested way. It's like a sort of a nephew of mine that I find extremely annoying, but occasionally pops up and does something stupid. But it's not really my problem. So, I do trade the Bitcoin futures, but, that they're one of sort of 200 futures I trade. So it's not really in or there for me, to be honest.
Tell you the truth, that was actually not what I expected in terms of answer when I asked you about what's been on your radar. I know we talked about it before we pressed record, because last time was actually around the day when the ETFs were launched. So we did talk about it last time, but okay, I will take it. Of course, I was kind of expecting you saying, "Oh, well, that's just been a Super Tuesday. Now we know it's going to be, the same horse race in the US."
There's no news. That's not really news, though. So
that's not really news.
Because the news is like something that's unexpected, And I think, you were looking, as long as like 2 months ago, you would have got pretty large odds on anyone except Trump winning the Republican nomination. So that's not news. I mean, it's depressing, obviously, that the US voters, the best two people they can come up with are a guy that's nearly 70 and completely insane, and a guy that's nearly 80 and completely insane, and a guy that's over 80 and, probably sane and competent, but he's over 80. So, is that really the best they can do? I mean, it's a bit depressing. Makes me proud to be British.
You may get some nasty messages in your feed labeling like that. I'm sure there will be supporters on both sides listening to us. Let's leave the politics there. Besides all of that going on this week, of course, is the fact that we've just had the Fed, Powell, in front of a congressional hearing, as he normally does from time to time. And you're absolutely right. There was nothing really new about that either, in the sense that, yes, they are ready to cut rates as and when, but it is not when, or the when is unknown at this point. So nothing new there. Let's quickly do a trend following update. Before you talk a little about trend following from your side, let me just say that, of course, we had very strong environment in January and February, and you could say in some respect March so far, although we're only a week in, it's a little bit different because things are relatively calm, pretty flat. What we saw in January and February, from where I'm sitting at least, was a pretty broad-based rally, if I can call it that, meaning many sectors participated in the performance. Of course, there were a few standout markets, but in a fully diversified portfolio, they're obviously not meant to completely dominate, but there were a couple of really good ones. So far this month, in March, there are a few of the markets that are still doing well: Mexican peso, cocoa, equities, and grains. But the fixed income, metals, and energies have kind of left the race right now and losing a bit of ground, as far as I can tell. So overall, the month is pretty flat. In fact, the BTOP 50 index is only up 9 basis points for the month so far, up 5.5 for the year. The SocGen CTA index, as of Wednesday, completely flat for the month, but up almost 6 for the year. Trend index almost flat for the month, but up 7.8% for the year. And the short-term traders index is down 22 basis points, up 34 basis points so far this year. Yesterday, I think, was an update, by the way, for CTAs. MSCI World up 60 basis points and up almost 6% for the month. World Government Bonds is up this month, actually, 70 basis points, thereabouts. And the S&P Total Return Index is up just a little, 19 basis points for the month, up 7.31% for the year. One thing that from time to time comes up, and I don't know, we talk too much about it, actually, but when it comes to trend, is the fact that we are seeing a lot of dispersion and have been for quite a while. And we'll certainly say that so far this year, between managers, I should say, certainly this year, there is a lot of dispersion in returns from what I've seen so far. What I can't help noticing is that to some extent, if I look at the sort of the rankings, managers who tend to trade fewer markets and are using dynamic position sizing seems to be leading the pack. And of course, this is a little bit against some of the discussions we've had over the years, where some of our guests and friends would argue that you need to have consistent position sizing, you need to trade hundreds of markets in order to catch the big outliers. all I will say, and it was really not to bring up a discussion about it, all I will say is just that I think what we're seeing right now kind of confirms the view that I've held for many years on the podcast, namely that I don't think you can say that one is better than the other, so to speak. They'll be better at different times, but I don't think you can say that consistent position sizing is better in the long run. I don't see any evidence of that. But anyways, it wasn't to raise a discussion. From your trend following lens, Rob, anything exciting that you see happening?
Yeah, I mean, just quickly, I certainly don't want to rake up the dynamic position sizing argument again, but if you look at managers who are trading fewer markets, you're going to see more dispersion with those managers, whereas managers that have got lots of markets can have a sort of more even set of returns. So if you were to look at the rankings of managers at any given time, you would expect on average that the managers at the very top and the very bottom of that ranking would be those with who are trading the fewest numbers of markets, just because they're more exposed to kind of random luck, if you like. So that's just a small point. So yeah, no dispersion here. I'm actually pretty much bang in line with the indices. So I'm up for the year. I'm not 5.9%. And if I look at where that came from, so yeah, it's across a mixture of sectors, but particularly did well in FX and in equities. And then everything else is kind of, I guess, a wash overall, some up, some down. In terms of individual markets, so interestingly, my best two markets were the Nikkei and the yen dollar. Obviously, those are kind of related. I'm also embarrassed to say that I made some money in Bitcoin, in Swissy dollar FX, bubbles, and in yen and euro. So very much a kind of Japanese theme there, I suppose. My worst markets, not really a pattern, but for what it's worth, my worst market was nat gas. So I'm kind of doing okay, and I'm sort of in a kind of close-ish to my high water mark, which actually I sort of set in sort of summer last year. So I've kind of crept up to that. I crept up to it, summer of 2022. Apologise. I did creep up to it late last year as well, but didn't quite make that high water mark. So hopefully that high water mark will arrive soon, because that's always a nice feeling. Just looking more generally, as you said, I think cocoa is the kind of standout market of the year so far. It's up a lot, not just on an outright basis, but also I look at markets on a risk-adjusted basis, and on that basis, it's up like 6-7 standard deviations for the year, which is obviously, a pretty big move. So there's also, but crypto's obviously up there, as we've discussed. So both Bitcoin and Ethereum appearing in that kind of top movers index, and down at the bottom is wheat. So wheat's on a vol adjusted basis, wheat's had a pretty weak year so far, to be honest. Looking on a sort of more summer forward-looking basis, and looking at the current positions that I'm holding at the moment, there's a very clear story actually, which is that I've got quite a big fat short in bonds, and a slightly not quite as big, but a long in equities. And then in the middle, there's not very much going on, to be honest, in the other sectors. So that's very much an obvious kind of pro-growth type trade, if you like, with an expectation that potentially that interest rates are going to rise to tame inflation, equities are going to go up. That's what the portfolio's positioned to do. My biggest long is still Nikkei, so still the Japanese market. And then interestingly, yen euro, that's still a big long. So that it likes those quite a lot. Ashamed to say I'm still long Bitcoin as well. And then on the short side, I'm short US 2s, US 3s, bubbles. So more of the short end of the curve. I'm not sure there's anything meaningful there, but it's just interesting to look at. But my biggest outright short actually is in Swissy dollars. So I'm certainly hoping that if I make a business trip to Switzerland anytime soon, that it'll become a lot cheaper.
Time will tell. All right, good stuff. Let's move on to the questions that we're going to tackle that came in from our great community. The first one is from Matthijs. He writes, as always, I love your show and look forward to the new episodes dropping every week. I have a couple of questions for Rob regarding choice of instruments to trade. I know that Rob excludes instruments with very low volatility, say less than 5% annualized, from his trading. There are various reasons to do this. One reason is that you require a lot of leverage to trade low vol instruments, which is dangerous if the volatility of those instruments suddenly spikes. My questions are, One, assuming that the trading costs are not a problem for some low-vol instruments, then how can we decide whether or how to still safely include the instrument in our portfolio? For example, take the short-term interest rates futures such as Euribor. Should we really exclude that from our portfolio, ? Or should we just size it small to manage the potential jump risk, just like we would for VIX futures, for example? Let's deal with that first.
I do exclude low vol instruments from my portfolio, but I'm basically not actually excluding low vol. I've got no problem with low vol per se. What I have got a problem with is high leverage. And of course, if you adjust position sizes for volatility, as we do, either sort of, at the point of the trade, open trade for the kind of classical trend followers, if you like, or dynamically throughout the life of the position, as I do. The smaller the volatility on an instrument, all the things being equal, the bigger your position needs to be relative to your capital, the more leverage you're going to have. And what that will obviously expose you to is a higher degree of a jump risk. So if you think about an instrument that, like, I don't know, the S&P, that normally has annualized risk of, say, 15% a year, in an extreme sort of situation, you might say, well, you might see risk of 50, 60% a year. That would be like the absolute limit. So that's kind of, it could go by about 4 times if you like. So, because your position sized for 15%, you're kind of, it's an acceptable risk as long as you've got lots of diversification. The real worry is if you've got an instrument with a very low amount of risk and you say, well, this thing's got a risk of, 1% or 0.5% a year, something like that. But it's not completely unbelievably inconceivable that the risk could go much higher. And you could have a very sharp move before you've had a chance to get out of your position. The classic example, which Matthijs actually cites in the second part of his question, would be something like Swiss Euro. So listeners will probably remember that the Swiss Central Bank effectively set a floor on the Swiss Euro rate of, I think it was 1.2. And the rate kind of bounced up against that, if you like. So if you actually measured the volatility of Swiss Euro, it was very, very low indeed. It was like much less than 1% a year, 0.5% a year, something like that. And then one day the Swiss Central Bank woke up, and I guess they'd had a bad evening, a bad night. Maybe they'd been out for a few too many drinks in the many nightclubs around the Swiss Central Bank, and they decided, let's get rid of this floor thing. This is ridiculous. So they just said, we're not doing this anymore, and then presumably went to get some strong coffee. And while they were doing that, the market completely panicked, and the Swiss Euro dropped by 20% in a matter of seconds. Which was obviously many multiples of what you would expect given what the standard deviation would be the day before, and that's the risk you have if you've got very high leverage. If you just naively keep leveraging up and up and up as the volatility falls. Now the title said, well, costs are a problem for low vol instruments, and they are. So all of the things being equal, you should look at costs on a risk adjusted basis. If you need to take huge leverage to trade something, well, that means that your kind of percentage costs are going to be much bigger relative to your capital. So your real cost a year of holding these positions can be much higher. So that's another reason for not doing it. But if we abstract focusedly purely on the jump risks size of things, there are other ways we could do it. So, the kind of quantity way is to say, well, I believe that the kind of historical returns for this instrument are an accurate reflection of what I could see going forward. And therefore, I could do something complicated like measure higher moments like kurtosis and skew. And from that kind of get a better idea of what the real tails are in this distribution. And you might want to do that in an asymmetric way. So you might want to say, well, go back to 2015. If I'd had a position on the wrong way around, the other way around with Swiss Euro, well, actually, I'm not so bothered about jump risk because, it's not going to affect me. The jump risk will always be in my favor, if you like. Whereas, if you have the position on, so you're expecting the peg to hold, then obviously you'd be terrified about the jump risk. And then there's a kind of less quantity way of doing that, which is, you could call it more a traditional risk manager approach, where you kind of go, stick your finger in the air and say, well, I reckon worst case scenario for this particular market could be a 20% drop, a 25% drop. So developed equity market, you could say, well, 87 could happen again. You could see a 30% drop. G10FX, you could say, well, you could see a Swissy event again, 20%. So you can kind of, Bitcoin, you could say, well, 80%, 100, it's not inconceivable. Now, the problem with both of these approaches is that they kind of assume that the worst thing has already happened. On the worst thing you're going to see in the future will be about as bad as the worst thing you've already seen, either in a very sophisticated, complicated mathematical way or in a figure in the air way. And you can imagine somebody going into the Swiss euro situation saying, well, G10 FX current currencies don't drop by more than 5% a day. That just that's never happened. So I'm going to use 5% as my, downside limit risk. Of course, that would have been a very expensive mistake to have made. So my personal belief is, effectively by limiting the leverage in a very crude way and saying I don't want leverage of more than X, what I'm effectively saying is that I believe that a large drop, like a 20, 25, 30% drop is very unlikely, but could happen in any one of the markets that I trade. And therefore I want to protect myself against being exposed to that. So it's a very, very conservative view. And that's purely because I don't believe you can ever really predict just how bad the future could be based on the past. You can get a good idea, and obviously all of the things being equal over the length of enough time, Swiss euro should be more stable and have fewer jumps than, say, Bitcoin. But that doesn't mean to say that there could be a kind of Armageddon event in the future that I haven't foreseen. And I just want to protect myself from that happening.
I guess, I think another way, of course, of doing it, but it has the same effect, I imagine, is just to impose a minimum volatility level, right? That you just simply say that, well, these markets, like we saw with actually short-term interest rates for quite a while, actually, that if you ignored setting a floor, you could have had some silly positions on also in those markets because they were so controlled and stable for quite a while. So I think most managers probably operate with a minimum level of volatility for each market, even if like a long-term level. Just to say, Niels, that's actually what I'm doing. Yeah. It's just that the actual calculation of that number, I use 5%, but I haven't just pulled 5% out of the air. 5% is basically based on me saying what my kind of maximum leverage is, and then from that I can back out what my minimum volatility is. So the constraint is actually minimum volatility. It's just that the point where I start about thinking it from is what's the worst drawdown I can suffer, therefore what maximum leverage should I take, therefore what's my minimum volatility. It affects a lot of markets. It affects not only the short-term interest rate futures, but also the short end of the bond curve. So, if for example, Italian 3 years, German 5 years, they're all in there. And then there's quite a few FX markets as well that are in that group. Then you've got JGBs, which again, I think the questioner writes about everything on the US yield curve in front of 5 years. It's quite a lot of markets. And that's maybe, 5% you could argue is a little bit too conservative for most managers. But because I'm doing this dynamic optimization, my view is, well, I don't have to trade, say, US 5 years, because I can trade 10 years, which is very highly correlated, and just effectively get my US rate exposure through that. But yeah, it doesn't rule out everything. As I've already said, I am trading. I do have positions in US 3 years and bubbles at the moment because there's also a degree of a kind of thresholding going on here. So what that means is if you think about something like bubbles, they probably bubble, excuse the pun, between a volatility of about, say, 4% and 6% a year. I don't want to be continually pulling them in and out in my system. So in practice, what I'll do is I'll allow a market that's, that drops temporarily below 5%, I'll allow it to stay in my portfolio. But if it goes, below, don't remember the exact number, but say it's 3.5%. If it goes below 3.5%, at that point, I will stop trading. I will close the position probably when I next roll it. So yeah, so I think you're right. Most managers use it. I'm a bit more conservative than most, but I've that's partly because I feel comfortable that I can still get the exposure through other markets implicitly. Yeah, no, absolutely makes sense. Well, hopefully that was some good, solid answers for Matthijs that he was looking for. Then we have a question from Ben.
Sorry, Niels. I think he's got a part two which I'd like to
answer.
answer.
But okay, you answer that. Okay, I thought actually you had already touched on the Swissy and the JGB, but go ahead. So the question is, how do we distinguish between benign natural low vol instruments and disasters waiting to happen due to artificial dampened volatility? So feel free.
Yeah. So the answer is it's very difficult. It's quite obviously you can look at the markets and say, well, I think that this market is being artificially controlled by the Swiss central bank, by the Japanese central bank, and therefore I'm not going to trade it. I have some sympathy with that view, and way back in 20, I think it was 2011 when the Swiss euro floor was first introduced, something like that, and I was still working for for a CTA at that point. I do remember saying in a very loud voice, guys, we should not trade the Swiss euro market anymore. It's just being controlled by the government. There's no fair price. I'm not so, the problem with that is there's kind of a grey area because it's you could argue, for example, that no one should have been trading bonds during the period of QE, right? Because, the government's controlling the market. To me, that's going a little bit too far. I mean, I guess if you're a tinfoil hat wearing conspiracy theorist, then, all markets are being controlled by a cabal of people somewhere, and choose the favourite group of people that you don't like who are controlling them. So that approach is I can see some validity in it, but for me, it's very hard to say unless it's, so an example of a currency that's completely pegged like Hong Kong US dollar. Yeah, okay, fine. That's definitely not something that's worth trading because the volatility is extremely low because there's a peg and, the best case scenario is there isn't really a best case scenario in that situation. Why bother trading it? I personally take the view that the 99% of the time it's okay to trade a market. If the volatility is low, I don't really care why the volatility is low. My rule is I'm just going to stay away from it because something that looks like, as a question that says benign low volatility, could easily become non-benign volatility very quickly. And that's true regardless of whether the market's being controlled by the government or not controlled by the government. Bad things can still happen.
Yeah, absolutely. All right, cool. Now we get to the question from Ben. And Ben writes, I feel as if there is a consensus that longer-term trend-following products produces better results, though there seems to be a fair amount of debate regarding timeframes, such as 20-day breakout versus 50 versus 100-day and whatever. But I would love to hear the discussion about how timeframes affect position sizing and the ability to get reasonable exposure to a market. A strategy might have a better backtest on a longer time frame, but the stop size would make some markets impossible to trade for smaller traders. Smaller positions allow room for more diversification in the portfolio, but there are so many markets a small trader can access. If I can't trade markets like sugar or OJ on a 20-day breakout, is it reasonable to do so, or is that quote-unquote too fast? Thanks for the podcast. I learn a lot from Ben.
Well, Ben, I'm going to teach you something else now because your questions actually, for me at least, is comes from a place of confusion and I think a misunderstanding of how risks and stop losses work together. But don't worry, this is very common. Actually, I've written a series of blog posts about it because it's something that a lot of people to me, it's an error that people make, a sense of confusion. So basically, your position size should be irrespective of how fast you're trading or where your stops are set. Position size should be according to the amount of risk you want to take in a particular market. And then your stops level should be set according to the speed that you're trading. So yes, if you're trading a very, very fast market, then your stops will be set tighter. If you're trading more slowly, your stats will be set more broadly. But the size of that stop is going to be completely independent of what your position size should be. Position size should be based on, the amount of risk you want to take in the market on a day-to-day basis, which is going to be, based on the risk, your risk target, the amount of capital you've got, the risk of the instrument, and the tick size of the instrument, assuming we're talking about futures. So, with that in mind, the answer to your question is: should we trade slow or fast? We don't need to worry about your capital because it's actually irrelevant. To be honest, capital might affect the instruments that you can trade, absolutely, because some instruments have bigger tick sizes than other, and the other thing is, of course, about low volatility instruments. You need bigger positions as well for low volatility instruments. So, as a smaller trader, you're kind of a little bit stuck with trading a subset of instruments that are have a small tick size and have relatively high volatility. But that apart, you can, your capital shouldn't determine, how fast you trade. And, I would say generally speaking, and you can spend a lot of time trying to optimize the correct holding period. And I've just gone through one of my periodic bouts of doing that, actually playing around with optimization. And the results are on my blog if people want to look. And every time I play around with optimization, I come to the conclusion that optimization is pretty much almost a waste of time. So there we go. You should probably trade as many time frames as possible. And I would also say generally that, especially if you're just starting out, lean towards trading more slowly rather than more quickly, because that will keep your costs down, and that will mean you've got kind of, less more room for maneuver in terms of not just bleeding your account dry just because you happen to be trading too quickly. I hope that makes sense, and apologies if I'm being a bit harsh, but it really. It's I don't know where this kind of myth that small traders have to trade fast because they can't afford the big stops of slower trading systems comes from, but suspiciously perhaps from the brokers, because they want you to trade more, and maybe that's where that comes from. I don't know. There's my conspiracy theory for you, Emil.
And the other thing, just regarding, which I think actually is a good point, maybe we haven't discussed it in detail and we're not going to go into it in great detail today, but you start out by saying, Ben, the thing about longer-term timeframes versus shorter-term timeframes. And I'm certainly one of the people who have argued that I think trend following is definitely better in the long term using longer-term timeframes. And what I base that on is obviously the research I have access to and what I see. But another way of looking at it, and one have to be careful when we quote every week, we quote the SocGen Short-Term Traders Index as one of the indices. And people who've been following it for any length of time will notice that it really hasn't produced much of a return for a long period of time. Now, I will say, though, I don't really think you can say that the managers in there are quote-unquote short-term trend followers. They're short-term traders. And so we just need to be careful about how we label that. But if you use a trend-following methodology, certainly the research that I look at would suggest that you have to be longer term to get the benefit of this approach. Anyways.
Just to confirm that, Niels, as well. I mean, my research shows that the efficacy of trend following most markets kind of starts to fall off when you get to holding periods of sort of a few weeks or less. And if you go really short term, you actually start to see mean reversion. And you're right. My suspicion is that a lot of the CTAs who are trading really quickly have got much more mean reversion in their system than they have trend following.
Yeah, cool. All right, then we have a question from, I would say it in Danish, Emil. I'm not sure where he comes from, but anyways, it's spelled like the Danish Emil or Swedish Emil. Anyways, it's a question that we actually forgot to, or maybe we didn't have time, or maybe I forgot it last time we spoke, because it's been with me for a while, so I apologize about that. But it's a completely different type of question, but actually it's an interesting one. So, and he specifically wanted you to answer it, Rob, because of your situation. So he writes, as a full-time systematic trader, how do you manage your expenses with up and down months/years? On the discretionary sides, it's easier to pick and choose your entries in a month. Also, if you find your losses clustered, I suppose this means that certain market conditions are not favored. Do you put anything in place to try and identify the issue?
So I'm going to answer these questions in reverse order, Emil. I'm going to start with the last one. By definition, a systematic trader should not be meddling with their system. They should be running it consistently. So that means, for example, so I just said, for example, that I've had a flat kind of P&L curve for the last 2 years. So I've lost, I was reached a new high water mark in summer 2022. And since then it's gone down, it's gone up, it's gone down, it's come back up again. And now it looks like it's near the high water mark again. That's just the fact, due to the fact purely that given the expected Sharpe ratio of my trading system, unless your Sharpe ratio is very, very high indeed, you're going to have, periods of months, maybe even years when your trading system is not producing any profits. Specifically for trend following, although my system is not purely trend following, but for trend following specifically, because it's a positive skewed system, that means that your return pattern is going to look something like 6, 7, 8, 9 months of losses and then 3, 4 months of gains, and those 3, 4 months obviously will, on average in the past will take you well above that previous loss level. But it does mean that you're going to be suffering from long periods when nothing seems to be working. And I can go back to an earlier period again when nothing, is probably 1, 2, maybe even 3 years of fairly flat performance, and then 2022 happened, and obviously that was a big gain. So, this kind of, I guess you could call it, down the stairs, up the escalator kind of pattern of curves means that that's just the way it's going to be. Although, there's nothing to stop you obviously researching, trying to improve your system, the last thing you want to be doing is saying, well, I've lost money over the last 6 months, therefore I need to change everything. That's a huge mistake.
Can I interrupt you here, Rob?
Yeah, of course you can. Go for it.
Because actually there's a great example that I had mentioned last week, but I think it's a great example. And that is that we've been talking about cocoa for the last, few months as, wow, what a trend. And it's been driving performance of many funds. But as far as I can tell, and I've also heard it from other people in our industry, cocoa didn't make money for trend followers for about 15 years or more. So I think that just goes to the point you mentioned there, Rob.
Yeah, I mean, I have my suspicion about cocoa because my youngest daughter is addicted to the stuff, and I think she's probably single-handedly responsible for driving up the price. Anyway, so that's all said on sort of meddling. On the second part of the question, on the discretionary side, it's easy to pick and choose your entries in a month. So I may be making the wrong inference here, but it seems that the inference is what he's saying is, well, if you're a discretionary trader, you can just choose when you print money, right? You can that's the inference to me. Like, discretionary stock trader, well, all you do is say, well, I want to make, say, $2,000 this month. I'll just pick these entries that are going to make me $2,000. Easily done.
NVIDIA comes to mind.
Indeed. I mean, I've sort of toyed and flirted with being a discretionary stock trader over the years, and I've never been very good at it, and I've certainly never done it professionally. So I'm probably speaking from a place of ignorance, but I'm pretty sure that it's a lot harder than that. I'm not, so just generally speaking, you're going to be have a smoother pattern of returns, so more kind of consistent returns if your system has broadly speaking, a higher Sharpe ratio. Ignoring the asymmetry around trend following versus non-trend following, we'll just move away from that for the moment. But so if you want a consistent pattern of returns, you need to have a higher Sharpe ratio, and that means you need to do one or two things: trade systematically, or be one of a very, very small number of people, very gifted people, who can do better trading systematically than they can in the discretionary sense. And even those very gifted people will never be able to make consistently money, sort of consistently month after month after month. The only people who can really do that are high frequency traders, which I guess you could call them the ultimate systematic traders, because the sort of trading they do is impossible to do for human beings. So I don't think there's any fundamental difference in terms of how you should think about managing your money or generating returns. Depending on whether you're a discretionary trader or a systematic trader, it's just going to be how profitable you are. For me personally, I'm much more profitable as a systematic trader than I would ever be a discretionary one. But anyway, so that's the second question. So the third question is a more interesting one, which is how, as a full-time systematic trader, how do you manage your expenses with up and down months and years? So let's ignore the systematic bit. Let's just say, well, you're a trader and you've got expenses. In my case, three children, one at university, a mortgage, 2 cats, a wife, and as I've already said, a massive monthly cocoa bill to meet. And you've got a trading system which, as I said, is unlikely to be producing like regular paychecks. So my trading system does not sort of send me a check for a few $1,000s every month, which is what would be happening if I was still, employed. So there's a number of different ways to deal with it. And the kind of main point to make is that you need to be, if you're really relying just on your trading income, then you need to be trading very conservatively. You need to be with quite a low level of risk, because you essentially want to be able to say, well, let's say if I I must make 20% of my capital every single year, then that's very problematic. Because although you might make 20% on average, in the years when you're down, you're not making 20%, you're still going to take that 20% of that out of your accounts. Your account's going to get lower in value, and that's going to make it subsequently much harder to make 20% the following year. If, on the other hand, you only need to make 5% out of your account, which now is, you can argue, well, why bother? Because that's pretty much where the risk-free rate is, right? But the hope is that if you're a good trader, you'll be withdrawing that 5% and making more on top of that, and that can then stay in your account and accumulate. And it gives you a buffer against the fact that if you have, bad periods, years when you lose money, or a couple of years in a row and you lose money, then you can take some of the money out of the account. It still doesn't affect you. The other way of doing it is by having a separate cash buffer. So what you say is, well, okay, I need to make 20% from my account every year, but I know there's going to be years when I don't make that. So what I'm going to do is maybe maybe not really pessimistic, but relatively pessimistic, and say, well, I'm going to assume there could be 5 years in a row when I don't make money from trading. And so I need to have a separate pool of money to cover those 5 years. So that means in practice is just completely arbitrary figures. Assuming you thought you'd need, say, $500,000 trading capital to meet $100,000 living expenses, you need to have another $500,000 of capital somewhere else that you can draw from. Now, from a kind of economic point of view, that's equivalent to saying you need to make 10% on $1 million. So it's actually economically equivalent to reducing your expected rate of return that you need from 20% to 10%, say, or 10% to 5% if you're going to be more conservative. From a kind of behavioral finance point of view, it feels safer to have this, this sort of 5-year cash buffer there, and then this trading account that's doing crazy stuff. And so, although it might not be as efficient for things like, margin usage and interest and all this kind of stuff, for that you probably would be better having all the money in the one account. In terms of, making you sleep at night, and also arguably lower counterparty risk towards your broker, it probably makes sense to have that separate pot of money there. And then what you do is when your trading account makes money, you basically take that money out of the account and you pop it into the savings account, into the surplus account, if you like. And so the value of that surplus account is going to be kind of moving up and down, as trade money kind of comes in, and the trading account, and then leaves again as you're spending your money. The value of the trading account is going to be kind of hopefully going up, spitting out some money when it reaches a high water mark, then going back down again, and so on and so forth. And that's basically the approach that I take. The difference is that instead of having a big pool of cash, which is very inefficient, I have a big pool of long-only investments, mainly ETFs, but also some stocks. Those also generate income, but they generate in the form of dividends, which obviously is not a guaranteed income stream, but is a steadier income stream, and psychologically, that feels better. So that's the other way of doing it. But yeah, I mean, just generally speaking, you'll need a lot more money to live off if you're trading for full time than you think you do, which is why for the vast majority of people, it's probably a really bad idea. You should only, even I don't live entirely off my trading earnings. Obviously, I have the massive royalties from the millions of books I sell every year, plus the £10 million a year that you pay me, Niels, for this podcast. Oh, sorry, I shouldn't have said anything. I'm going to upset the other guests.
Yes.
But yeah.
The other thing I was going to say, just to wrap it up, because we need to move on, and that is just that if you are a systematic long-term trend follower, you can easily have a job next to being a long-term trend follower, because it doesn't take many minutes per day if you've structured it correctly to run such a system. All right, now we're going to move on to today's main topic, I would say. It is a paper from our friends over at Man Group. It's from a series called The Road Ahead series, and it's written by Henry Neville, who is a portfolio manager at Man Solutions, and it's called Regime-Based Investing. Now, I'm going to let you drive this, Rob, but essentially, if I can set the stage, it's looking at different investments and how they perform during, I think, 7 different regime definitions. And they look at 6 different assets or strategies, that being equities, bonds, commodities, long, short equity. What else do they have? Equity, cross-sectional momentum, and trend following. Now I'm going to let you talk through the different regimes and what the key takeaways are, Rob, because I actually thought it was an interesting way of discussing some of the things that we love to talk about.
Yeah, absolutely. And so I'm a bit of a fan of Henry Neville, actually. I've never actually met him because we didn't overlap at Man Group. But Henry, if you're listening, I'm now your biggest fan, and I'm going to read everything because you write very well. You've got a nice writing style. It's easy to read, and also your stuff is quite short as well. You say in this report it's a bit long on page count, but it's mostly pictures, very few words, which is great. A lot of people who write this stuff, particularly on the sell side, do tend to rather spend a lot of time on word count. You've got a point to make.
Yeah, and just before you jump in, I'm just going to say that I will link to this paper, of course, in the show notes of this episode.
Yeah, definitely. So this regime analysis is something that people like to do a lot, interestingly. But it's quite nice to see all the different sort of styles of regime kind of wrapped into one place. So I guess there's this, broadly speaking, I guess you could say two main ways of categorizing regimes. So one would be like a macro view. So you look at something like inflation or growth or the unemployment rate, something like that. And the other thing is a market regime. So you could look at, say, bull or bear markets. This paper's got a mixture of both, which is nice. The set of assets that Henry's analysing, just to say it's equities, bonds, commodities on the long only side, and trend, and then two long short equity strategies, value and then cross sectional momentum, which obviously is going to be correlated to trend, but not quite the same. So so it's quite interesting. Just one thing to say on this sort of study, I think a lot of people make the mistake of using it, thinking they can use it as some kind of way of switching between strategies according to the regime that you're in, because that's what you assume is going to happen. But I've read this quite carefully, and Henry's not making the claim that you should do that, and that's because his regimes are classified in such a way that you can't actually predict what regime you're going to be in, say, over the next 6 months. The regime classification is done in a way that's not necessarily, you can't necessarily tell which of these regimes you're in today. It's almost a purely backward-looking exercise. Now, you could do that, and my experiences with that approach is that it tends not to be very successful at predicting returns. So, for example, very trivially, if you knew in advance that the next 6 months was going to be an equity bear market, well, go short equities and you'll make lots of money. It's much harder to do that than you might think. It's a bit easier to say, well, I think there's a recession coming. We're reasonably okay at predicting recessions over the next 3 months or so. Not a bit harder to go further out, unless, of course, we get a massive exogenous shock like a COVID or something, or a UK government fiscal event, for example. But there's a weaker link between recessions and investment performance than there is between, say, a market-based regime and So all of those caveats out of the way, it's still a very interesting thing to do. So it's very hard to summarize. It's 11 pages and it's lots.
Well, let's talk about the regimes, right? The first one is inflation.
Inflation, yeah. So let's structure it like that. So inflation regimes. So basically, we've got 4 different regimes. We've got reflation and disflation, and we've also got fire and ice.
So maybe I should just explain. So fire is when CPI year on year moves above 2% through 5%, and then it peaks. And ice is where CPI moves below 1%, then below -1, ending either in a trough or where it goes back through -4%.
Yeah, so one thing I have to say, although I'm a fan of this paper generally, I'm not really a fan of with these regimes being very kind of, if this was a quantitative exercise, then categorizing regimes that way would very much be overfitting, I would say. But let's move. I would probably do something simpler, like, is inflation low and falling? High and rising, high and falling, or low and rising. I would do it like that, because that's the simplest way of doing it, and less chance of overfitting. These regimes roughly approximate to that, but not quite.
What do you take away from the inflation regime? Is there anything you take away from their analysis that sort of stands out in your view? Because he talks about the returns and he talks about the hit rate for each of the asset classes.
He does, yeah. Now, these aren't quite the same thing. So all of the things being equal, you want a high hit rate and you want high returns. But as we've already discussed, if you take a strategy like trend following, it's got quite a low hit rate. But on those occasions when you are right, you make more money. So it's quite nice to see hit rate in as well as returns, because it gives you a slightly more nuanced flavour of what's been going on. And then Henry seems to favour hit rate because he kind of colours in the hit rates, which is, maybe because it's more obvious what a bad hit rate is and what a good hit rate is. A good hit rate obviously is going to be something well above 50%. A bad hit rate is something well below 50%. Inflation is interesting because there's often these sort of stylized facts about so we know that bonds do badly in inflation periods, right? That's kind of well known. It's less obvious what equities should do in inflationary periods. And actually he finds that both equities and bonds do quite badly in the FIRE regime. So that's kind of interesting because, it's not necessarily obvious whether equities should be inflation hedges or not. On the other hand, commodities do extremely well in the FIRE regime, as does trend, incidentally. So both trend and commodities would look like good kind of hedges against the sort of high and accelerating inflation that the FIRE regime implies. And of course, that's what we saw in 2022, of course, yeah.
What stands out to me also is that there's actually only two asset classes that has a positive return in all four different regimes. One is long-short equity value, but in two of the occasions, in FIRE and reflation, they make no return, but they make small returns in disinflation and ICE. But actually, trend following has good returns in all four.
Yeah, so, spoiler alert, people, and we probably wouldn't be talking about this paper if it wasn't the case, but trend following really wins in this report. In pretty much every type of looking at regimes, it's the only strategy that performs consistently across all the different regimes that are looked at. So you can stop listening now if you like, or you can continue while we talk about a few more. The next regime he looks at is real growth, and this is divided into recovery, slump, boom, and recession. So this is a more natural way of doing it. So recovery means growth is low and rising. Slump means growth is low and falling. Boom means growth is high and rising, and so on and so forth. So you get the idea. And then the recession categorization is the standard NBAR definition of a recession. And of course, there's a bit of hand waving going on here because a lot of these sort of categorizations are done purely on the US economy. Whereas, of course, definitely commodities and trend following is going to have exposure to lots of different countries. So it's not, but the US is the biggest economy and global economic cycles are kind of correlated. So it's not really a big issue. So let's take the recession as the starting point. That's the one everyone is less keen on. So equities and commodities do badly in recessions, bonds do well. So that you'd expect that, right? Because generally speaking, central banks cut rates during recessions and real assets do badly. In recoveries, the picture is pretty much reversed. So bonds actually don't do so great because obviously central banks are increasing interest rates. And I guess that's what we saw kind of certainly late 2022, early 2023, definitely that kind of regime, whereas equities and bonds do well. And then the other kind of regimes there's not so much of a clear pattern, but of course, once again, trend following. Although all the kind of long short strategies do okay across all the different regimes, but trend is also a consistent performer across all the different regimes. So another win for trend following. So the yield curve for me is quite interesting because I've actually looked at this myself because there was certainly, going through the early 2000s, there was this kind of, everyone was saying, CTAs have done really well. Well, a lot of that return has come from the bond sector. A lot of that's come because we've had a secular downtrend in interest rates and the yield curve has been upward sloping. So bonds have just been this perfect straight line of yields falling, positive carry. You guys are going to be in real trouble when they raise, interest rates start going up. You're going to be in real trouble. Because, of course, as everyone knew, in the early 2000s, it's actually illegal for CTAs to go short fixed income. apparently. I'm being sarcastic. So I've done work on this myself. So the definitions here for the different regimes are, again, to me, quite logical. So you've got bear flattener, bull steepener, bull flattener, bear steepener, and obviously, and then a yield curve inversion. And if you go back and listen to the episode we did with Cam Harvey a few years ago now, you'll know that an inverted yield curve is one of the best predictors of recessions. And spookily, there was one in 2019 which predicted the COVID recession even before COVID was a thing. That's how good the inverted yield curve is at predicting recessions. So it
hasn't quite predicted the current regime, right? Because there has been an inversion since, and we're still waiting for the recession.
Well, you say that, but in the UK, we've had 3 quarters now of falling growth. So
I'm, of course, talking about the US economy, but there we are.
Of course you are. Maybe we should have Cam back on again
I think we could be
defend his record. So yeah, given that it's correlated with recessions, you'd be perhaps surprised to learn that bonds don't do very well with an inverted yield curve, but that actually makes sense if you think about it, because of course inverted yield curve means you've got negative carry. So although you'd expect to gain as the curve kind of uninverts and the short end comes down, generally speaking, while the yield curve's inverted in that sort of almost pre-recession part of things, you've got the headwind and negative carry, so you're not doing so well. The kind of single biggest numbers here are on the steepness. So a bull steepener is incredibly good for equities, incredibly good for bonds, pretty much good for everything. Trend does pretty well in that environment as well, as you'd expect. A bear steepener, on the other hand, is very good for commodities. Everything else doesn't do so well, So these things are the bonds returns for the yield curve regimes are almost kind of like a mathematical expectation of what you'd expect. The others are perhaps more interesting. Okay, so equity markets. So this is the S&P 500, and we're just doing bull and bear markets. That's obviously quite an easy regime to work out. Is the market currently going up or going down?
And I think we should qualify and say that I think all the regimes had to last for a minimum of 6 months. Is that right? Is that how I remember it?
So
something like that.
I can't remember the footnotes, but for a lot of these definitions, like recessions, technically speaking, a recession has to be 2 quarters long. So that's going by construction going to last for 6 months.
But people should read the footnotes if they're going to read the paper. They shouldn't just be trust our memory.
I mean, there's a very brief. I don't think that's true generally, because, for example, the October 87 crash is marked as a bear market that lasted for about 2 months in the data. So I don't think it's true that all the regimes had to last for 2 months.
It may not be related to the equity markets, but some of the other inflationary regimes and all that stuff, I just seem to remember.
Anyway, so let's look at the equity market regimes. So you're going to be shocked to hear this, Niels, but apparently equities do really well when there's an equity bull market and really badly when there's an equity bear market. So that's surprising for me, to be honest. The other strategy is obviously going to be more interesting. Bonds, not really. They do actually better in an equity bull market. That's maybe just reflecting the fact that the correlation of stocks and bonds for a lot of this period, because this particular data set goes back to the mid-1920s. So for most of that period, stocks and bonds have been correlated. There's this weird period in the last 25 years up till about 2022, and they were negatively correlated. But that was actually unusual historically. Commodities do better in an equity bull market. That makes sense to me. In an equity bear market, though, you really want to be trading, value, cross-sectional momentum and trend. So the kind of alternative assets do much better in a bear market than a bull market. So that's nice, because if you're buying them as an equity hedge, then at least historically they're giving you that performance. That's good. One thing so there's been clearly some real work behind each of these tables. So it just occurred to me that, for example, to calculate like an equity long-short value strategy back to the mid-1920s is actually quite a feat of data engineering. So I don't know whether he did that himself or sourced that from another paper, but kudos to whoever did that work, because that must have been quite a bit of work. Okay, we're getting through them. So monetary policy. So this is what's happening to the Fed funds rate. Is it tightening or is it loosening? Obviously, that's going to be a bit related to the yield curve stuff we've seen later. But anyway, so loosening monetary policy, you would expect to be good for equities. It is. It's also good for bonds. So that's almost a mathematical fact that if interest rates are going down, you should own fixed income. It's also, most assets are kind of do pretty well there, I guess. Maybe on the tightening cycle low, equities still makes money, although not as much. Bonds loses money. Again, mathematically, that's what you'd expect. If interest rates are rising, fixed income should lose money. Trend, of course, does equally well in both environments, although a little bit better in the tightening environment than the loosening environment. So again, it's sort of a nice little hedge against, what's happening with the Fed.
Actually, one thing that surprised me when I just looked at the table right now, and that's obviously because we don't really think about what happened all the way back to 1947 or whatever the number is. I feel that my memory is that, we live in an environment that most of the time is loosening, right? In fact, over the full period, there is actually 56% of the time that is a tightening period, which is quite interesting. Goes to your point from before that the period after GFC and maybe leading into it was a very unusual, both with correlations in terms of stocks and bonds, but also certainly in terms of central bank policy.
Yeah, I mean, so this particular data goes back to 47, and obviously from 47 to about 1980, we had a secular uptrend in interest rates. So there would have been a higher percentage of time spent tightening in that period. And then since then, we've had a secular downtrend in interest rates, only interrupted in the last couple of years. So yeah, we see both of those, but there's obviously a bias towards tightening in the first bit of the period and a bias towards loosening in the second bit of the period. And this is where these sorts of exercises become a little bit less, can you really say that if when you're basing all of your facts on what's happening in a tightening environment, in what happened between, 1947 and 1980, pretty much, is that really relevant to what could happen in the future? So, as I said, there's a backward-looking exercise. There's nothing wrong with this. As an exercise in trying to infer what you should be doing in the future, you have to be a bit more careful about that because of that sort of bias effect. Okay, the next one's the commodity curve. So this is whether the futures curve is in backwardation or contango. And every time I talk about backwardation or contango, I say two things. Firstly, if I ever go out and buy two dogs, I'm going to call them backwardation and contango because I think that would be a cool name for dogs. Sadly, as I said earlier, we're actually a cat family, so that's never going to happen. And the other, and also my family would never permit me to call the animals that name. Secondly, I can never remember which is which is a bit embarrassing as someone who's written a book called Advanced Futures Trading Strategies. You kind of expect me to know which is which.
Do you want me to help you here? First of all, I would say if you do buy two dogs and you're not sure which one is which, then buy a white dog and a black dog. That might help in the first place.
Okay.
But I can help you a little bit because as far as I remember, contango is kind of what I think of the norm, meaning that the further out you go, the higher the price, meaning, you should be paid more if you think about it in terms of yield. So the further out you should go, you should theoretically get a higher yield for taking more risk. So in contango, future prices are higher than current prices, and backwardation is the opposite.
Right. Okay. I just think about.
You're not sure, but there we are.
Yeah, I think about positive and negative carry, and to me, I don't see any need to learn two pieces of jargon that I have no need to know, unless it comes to animal naming. Anyway, having said that, so they look at the commodity space in aggregation, and I don't know exactly how they've measured this, but anyway, so the market spends 62% of the time in contango. And that's again since the mid-1920s. And interestingly, there's been more contango, I would say a little bit more on average in the second half of that period than in the first half of that period. So the backwardation tends to come from the kind of, particularly the 1940s were a big time for backwardation, apparently. So you wouldn't expect much of an effect in sort of the equity and the bond space. Equities do a little bit better when the commodities are in contango. Bonds do a little bit better as well. I'm not sure how meaningful these figures are, to be honest. I suspect it's what we would call, econometricians would call a case of a missing correlated variable. So basically, it's quite likely that backwardation and contango is driven by things like inflationary environments, monetary policy environments, and so on and so forth. And that's why the equities and bonds have got a different pattern. I'm not sure you could say there's a direct driver between what's happening in commodity curves and returns of equities and bonds.
But what is interesting about the numbers is that equities and bonds are the only two assets that do better in contango, meaning in sort of normal environments. All the alternative strategies and commodities do better according to their numbers when things are in backwardation. So in a sense, you could say, I mean, you have to assume these numbers and just take them as they show up.
Yeah, we're talking pretty small sample sizes here, and some of the differences are very small. So for example, long-short equity value, the hit rate in backwardation is 63% and in contango is 60%. I haven't done the maths, but there's no way that's statistically significant. I mean, really, the only two asset classes that are interesting for me here are commodities and trend, because obviously commodities are the things that, so unsurprisingly, the figures are quite interesting for commodities because if you look at the returns, in backwardation, commodities make 8% a year, and in contango, they make 2% a year. If you look at the hit ratio, it's the other way around. So in other words, in contango, the hit ratio is 50%, and in backwardation, it's only 50%. Now,
80%, sorry. 80% in contango.
Yeah, exactly. Yeah. So from a hit ratio point, it's better. But again, this comes down to this argument about asymmetric returns and skew and so on and so forth. But just focusing on the returns numbers, those are what I would expect. So basically, this is telling you that carry works in commodities, because if you look at the shape of the curve and take a position based on that, that's effectively a carry strategy. Trend is better in backwardation, quite a bit better on the return, a little bit better on the hit rate. Again, that makes sense to me, to be honest.
Right. Let's do the last one, and then
So value versus growth. So this is looking at whether the farmer French value factor is kind of doing well or doing badly. So, for example, you would expect that going into the 2000 tech bubble, that growth would be great and value would be bad. That's what you would expect, right? So there's been a longish period until about, I think it was 2021, when value looked pretty bad, and Cliff Asses at AQR was writing articles saying, guys, this is a great time to buy value because it's just getting cheaper and cheaper, and everyone was saying, is value dead? And then it kind of has come back a bit, although just recently these tech stocks that it's hard to mark up as value. So if you're doing extremely well, and Warren Buffett's kind of saying there's not a lot of value out there, so maybe it's not a good time for value at the moment. Anyway, so they split regimes into value and growth. The market spends more time in a value state. All that is saying is that value works on average more than growth. And interestingly, equities do better in that value state, at least on the return. The hit rates are the same. I'm not completely sure the interpretation of that is. Maybe it means that on average more equities are value. That's certainly not true of the current S&P 500. So, I'm not sure how to interpret that. Obviously, again, for most of the asset classes here, the link's going to be tenuous. So if trend, for example, does make positive returns in both regimes, a low value is better for it. But I couldn't tell you why. I think that would be a data mining exercise. So what you really want to focus on is long-short equity value. That of course is the, is the one you'd expect to see a very clear pattern. And naturally, that does very well when value is doing very well. And it does very badly when growth is doing very well. That's exactly what you'd expect. Long-short cross-sectional momentum in equities, which is sort of, to a first approximation, going to be value with a -1 sign in front of it. Again, so you see exact. So that would be true if all the counting ratios stayed the same, basically. That is, does very well in the growth regime, not so bad in the value regime. But yeah, so be careful with this stuff for lots of reasons. As I said, regimes aren't balanced. You get biases through time. But there are some conclusions at the end. One, of course, as we've already said, is that trend is great. It doesn't matter how you split your regimes up. It just makes positive returns in both of them. So that's wonderful. I think beyond that, I'm not sure that there's much mileage in, for example, saying, oh, wow, we're now in a bull steepener growth recession where and it's a bull market, therefore we should buy commodities. I'm not sure whether you can take the inference to that level.
No, and don't think Henry was expecting anyone
no,
to do that. No,
of course not. I'm just a warning sign, because people I think do think that this regime classification is an excuse for kind of changing your portfolio allocations, and it shouldn't be.
No, for me the big takeaway really is I think it's good to visualize some of these things, as you point out, and of course we we didn't write this paper, but we are positively just we like some of the conclusions, some of the numbers we can take from it. But I think to me, it actually just confirms my own intuition, and that is trend is a pretty robust and adaptive strategy, and therefore it's not surprising to me that it does pretty well in most of these different regimes. That's kind of how I would leave it for today. And unfortunately, we have to leave it for today. We've gone a little bit over our usual time, but I appreciate, Rob, for you coming on and for taking us through all of these different topics and questions. Next week, I believe I'm joined by Katie. So that's going to be another fun and insightful conversation, no doubt. If you have questions for Katie, send them to info@toptradersunplugged.com, and I'll do my best to pitch her your questions. If you enjoy these conversations and all the work that Rob puts into preparing them, go to iTunes, go to Spotify, go to Amazon, wherever you listen to your podcast, and kindly leave a rating and review so more people can find these conversations. From Rob and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, as usual, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.